to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or buy rating on my 33-question research checklist. Today, we're shining the spotlight on Gartner Inc., ticker symbol IT, and uncovering what makes it a standout investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. So the first thing that I like to go over is the investment checklist and database. I have a 33-question checklist that evaluates companies across 9 categories, including fundamentals, management quality, industry position, fundamental and technical momentum, historical and future growth, valuation, capital allocation, and solvency and liquidity. By examining these diverse aspects, we aim to gain a holistic understanding of a company's strengths, weaknesses, and potential as an investment opportunity. So far, I've screened 191 stocks across 9 sectors with a mean score of 58%, a standard deviation of 15%, and a top quartile benchmark of 70%. 83% of the companies analyzed have been large caps, followed by 16% mid caps and 1% small caps. From a sector distribution standpoint, 20% of stocks analyzed are in consumer discretionary, 18% in information technology, 16% in industrials, and 13% in healthcare. All other sectors are below 10%. For Gartner, they earned a quality score of 67%, which is in the 68th percentile, and technically a watch on my initial investment checklist. For Schwab, they got a rating of A, and Guru Focus gave them a score of 91 for the 65th percentile. So given that we've all rated them fairly well, this is a company that I wanted to dive deeper into. We'll now jump into the business and industry overview. In terms of a classification perspective, the GICS classification classifies them as a computer services industry within the information technology sector. They are a large cap company at a $39 billion market cap as of September 18th, 2024. I next like to analyze their core operations, which I've broken out into products, services, and evolution. Gartner primarily offers research and advisory services, conferences, and consulting to technology executives. Their key services include subscription-based access to proprietary research, data, and benchmarks, direct consultation with research experts, flagship symposium events for networking and insights, and customized consulting solutions. Gartner's services are increasingly vital for long-term competitiveness and efficient IT management. While most services are essential, some aspects like certain research subscriptions or consulting services may be seen as discretionary expenses during cost-saving periods. I'd now like to talk a little bit about the evolution of Gartner. Gartner has evolved from its origins as a technology research firm in the 1970s to become an IT advisory powerhouse. Over time, they expanded their services to include consulting and events and developed influential tools like the Magic Quadrant. For those that don't know, Magic Quadrant is a market research report that visually represents the competitive positioning of technology providers based on their ability to execute and completeness of vision, helping organizations make informed decisions about technology investments. As part of its evolution, the company is also expanding beyond its focus of just traditional IT, providing insights into digital business transformation and the impact of technology on various industries. I'd now like to talk about their business segments and geographies. Gartner operates through 3 main business segments. The first being research. This is their largest and most profitable segment, which contributes over 80% of net revenue and almost 90% of gross margin mix. In 2023, the research segment generated revenues of $4.9 billion. It provides subscription-based access to actionable, objective insight, guidance, and tools for executives and their teams across all industries. This segment has shown a strong recurring revenue growth, even increasing by 7% during the pandemic when other segments experienced declines. The next segment is conferences. This segment organizes events that provide executives and teams the opportunity to learn, share, and network. In 2023, the conferences segment generated revenues of $505 million. They account for about 9% of 2024 net revenue guidance. Gartner Consulting is the third segment, and it's actually an extension of their IT research business. and it serves senior executives leading technology-driven strategic initiatives. On their 10K, they specifically mention IT cost optimization, digital transformation, and IT sourcing optimization. In 2023, the consulting segment generated revenues of $515 million. They account for about 9% of 2024 net revenue guidance. Next, geographies. Gartner is a global company, but the North American market is the most important market to their business. Their 2023 revenue breakdown by geography is as follows. For United States and Canada, this region is their largest market, which generates around $3.9 billion in revenue last year and is 66% of net revenue. The second geography is Europe, Middle East, and Africa, EMEA. This is the second largest market for Gartner. It contributes $1.3 billion in revenue and accounts for about 23% of net revenue. They also have an other international category, which likely includes Asia Pacific and Latin America. This geography generated $0.7 billion in revenue, contributing about 11% to net revenue. The research segment remains the dominant revenue generator across all geographic regions, followed by conferences and consulting. I'd now like to talk about their customer base and market dynamics. Gartner's customer base is highly diversified across many industries, which is one of their biggest selling points as a business to me. They claim to serve more than 15,000 clients in over 100 countries, including over 70% of the Global 500. This diversification helps them maintain stability in their revenue streams. In terms of their core customers are tech-savvy leaders such as C-suite executives and senior IT managers who are forward-thinking yet risk-averse, relying on data-driven insights to inform critical technology decisions. They seek objective analysis to mitigate risk, gain a competitive advantage, and validate their strategies, while also valuing opportunities for peer networking to optimize their organization's performance. Next, I'd like to talk about seasonality. While specific seasonal trends are not explicitly mentioned in the 10K, Gartner's business model likely provides relatively stable revenue throughout the year. However, it is worth noting that the conferences segment may experience some seasonality based on the timing of major events throughout the year. I next like to evaluate industry attractiveness, and this is something that I called competition and competitive advantage in my last episode, and I've actually decided to change it to industry attractiveness. And it's because I believe that finding a good industry is as important as finding a good business. Gartner's industry appears to be an above-average industry for an investor, primarily due to its strong growth prospects and the increasing demand for technology insights in a rapidly evolving digital landscape. Gartner estimates their total addressable market, or TAM, of being approximately $200 billion. As of June 30th, 2024, Gartner's contract value, or CV, stands at $4.9 billion, which represents only about 2.5% of this market opportunity. Gartner projects that even if they grow their current CV at a 15% growth rate, or CAGR, for the next 15 years, they would still only capture slightly more than 15% of today's addressable market. This indicates an extremely long runway for growth within the industry. In terms of competition, Gartner and its competitors primarily compete on the quality of research and expertise, brand reputation, and diverse service offerings. While Gartner faces a lot of competition from independent information providers, consulting firms, and media companies, they stand out due to their superior research content, trusted brand name, and extensive global presence. Their proprietary frameworks, like the Magic Quadrant, have become industry standards. Notably, the absence of explicitly named direct competitors in their 10K suggests that Gartner enjoys a relatively unique standing in their core markets. Two of their largest direct competitors are Forrester Research, ticker symbol FORR, and International Data Corporation. They are not publicly traded. Forrester is a $357 million research and consulting firm similar to Gartner, but with more of a focus on customer experience and with less global presence. IDC is a subsidiary of International Data Group, IDG, which was actually acquired by Blackstone in 2021. When analyzing the three companies on Comparably, Gartner scores better than both competitors. They have a 78% customer loyalty score and a plus 28 NPS versus Forrester's 72% customer loyalty score, plus 11 NPS, and IDC's 69% loyalty score and plus 19 NPS. Overall, Gartner appears to be a leader in a growing industry. I'd next like to talk about their business model and high quality attributes. Gartner's business model is primarily subscription based, with 76% of revenue coming from recurring subscriptions in 2023. The company generates revenue through multi-year contracts for research products, with an average length of 1.7 years and high retention rates of 80 to 90% for research clients. Revenue is recognized ratably over the contract term, with fees typically billed up front, creating a favorable cash flow timing relative to revenue recognition. This model drives strong free cash flow generation. While research subscriptions form the core of Gartner's revenue, the company also generates income from conferences and consulting services, which are recognized upon completion or as work is delivered. For marketing and distribution, Gartner promotes its services through thought leadership. One example is the Magic Quadrant tool, and also through events and conferences, where they provide value to attendees and also promote their brands and services. In terms of distribution, Gartner primarily uses a global direct sales team to develop relationships with CIOs, IT professionals, and other senior executives. I then like to look into their production and pricing. They don't manufacture physical products, so their primary production in this case is just intellectual property in the form of research reports, analysis, and advisory services. I do believe that Gartner has strong pricing power in the technology research and advisory industry. Their services are considered essential for many businesses, especially in IT decision-making processes. I also believe that their pricing is relatively inelastic because their research is often a small percentage of a company's overall IT budget, but it can influence much larger technology investment decisions. Gartner's high client retention rates, which are 80 to 90%, and wallet retention rates, which are between 100 and 115% annually, indicate that customers find significant value in their services, allowing for consistent price increases. Lastly, I like to look at supply control. While there's no hard cap on their ability to produce research or provide advisory services, there are natural limitations based on the number of expert analysts they employ and the time it takes to develop high-quality insights. In this next section, I like to pick two qualitative high-quality attributes for each company that I'm analyzing. In Gartner's case, I'm choosing strategic positioning and financial stability. For strategic positioning, I specifically want to talk about their customer base. They serve over 15,000 enterprise clients in more than 100 countries, spanning industries such as technology, finance, healthcare, and government. I really like how diversified Gartner is from an industry and sector perspective. I think this is a unique aspect of their business model. In terms of financial stability, I want to talk about their resilience. Gartner has only had 4 years of negative revenue growth since 1996. During the 2008-2009 financial crisis, their revenue decreased by 11%, while many companies faced 20% plus declines. They went on to then increase revenue at double-digit rates for the next 5 years. Similarly, in the COVID-19 pandemic, Gartner's total revenue for 2020 was just a 3% drop from 2019, and by 2021 they had rebounded to $4.7 billion in revenue, which was a 15% increase. This resilience highlights the essential nature of Gartner's research and advisory services. I then like to take each company through some quantitative high-quality attributes. I like to first look at returns and predictability. First thing I like to look for or answer is the annualized price return CAGR, or growth rate, greater than the S&P 500 since portfolio visualizer tracking began? Data goes back to June 1997 through August 24, and in that time period, Gartner has beaten the market 11.2% to 9.1% with a 0.50 or average correlation. I also like to understand if there's been any EBIT operating losses over the last 10 years. Gartner has had one EBIT operating loss in the last 10 years, and this was in 2017. This was due to a one-time charge with its CEB acquisition. So no real concern there. I also like to see if Gartner's predictability rating on Guru Focus is at least a 4 out of 5. There's some research out there showing that companies with higher predictability ratings on Guru Focus's database actually perform better long term on stock price appreciation. Gartner actually does not. They score a 3 out of 5. This was slightly surprising for me to see. Not a big deal, but worth noting. I then like to analyze whether 10-year free cash flow linearity is at least 0.75. In Gartner's case, it is. The R squared is 0.79. I then like to look at their margin, specifically gross margin and stock-based compensation adjusted free cash flow margin. For gross margin, we're looking for over 40% 10-year average. Gartner has a 10-year average of 64.33%, way higher than my benchmark. For the 10-year SBC adjusted free cash flow margin, I want to make sure this is over 15%. Gartner's is slightly below at 13%, but it is worth noting that the margin has been trending up in recent years, with the last 3 years, 2021 through 2023, all above 15%. As I mentioned in the first podcast, I look for quality growth companies. So a few things I'm looking for from a quality growth perspective is 10-year revenue growth rate at least 5%. The answer for Gartner is yes, it's 11.3%. This growth rate suggests that Gartner has been successful in expanding its business through both organic growth and some strategic acquisitions. Next is 10-year free cash flow per share CAGR, at least 10%. Yes, again, Gartner's is 14.5%. It's nice to see that free cash flow per share is compounding higher than revenue. Lastly, I like to look at is 10-year average free cash flow conversion, which is free cash flow per share divided by net income per share, at least 100%. This is yes, and if you exclude the 2017 outlier year where they had a really high free cash flow conversion still averages out to 188%, indicating that Gartner consistently generates free cash flow well in excess of its reported earnings. I then like to see if Gartner has high returns on capital. The first thing we'd like to know is 10-year average ROIC at least 20% and ideally higher than its 2023 industry average. 10-year average ROIC for Gartner is 18.54%, which is just shy of the 20% top quartile benchmark in my database. However, the company has shown good performance in recent years with a strong 26% ROIC in 2023, which does surpass the industry average of 24.17%. This is good to see the upward trend with Gartner. I then like to look at Guru Focus and say, is the current ROIC at least 2% greater than their cost of capital or WACC? As of September 17th, 2024, Guru Focus has their ROIC at 12.77%, which is 3.3% higher than their 9.45% WACC. Next, I like to look into a couple of growth areas and risk factors with each business. For Gartner, overall, I rate them as having medium growth potential. Probably the area where they are going to experience the most growth is just an increasing demand for IT advisory services. Worldwide IT spending is projected to grow around 8% to $5.1 trillion in 2024, and I believe Gartner is well positioned as a market leader to benefit from the rising need for expert guidance. I've also listed out two other growth areas for them. First is expansion into opportunities in emerging markets. In 2023, non-US Canada markets contribute approximately 34% of Gartner's net revenue, which was up slightly from 2022. As these markets continue to develop, they may become increasingly important contributors to Gartner's overall revenue and growth strategy. I also have small accretive M&A deals as the industry potentially consolidates. And one thing I've noted here is that recently MPD and IRI have combined as part of Circana. So I think you'll continue to see industry consolidation in the future. In terms of risk, I also rate them as having medium risk potential. 3 risks that I've noted is 1, rapid technological changes, which specifically in AI could potentially erode their advisory services relevance if the company fails to stay ahead of these advancements. There's also some dependence on non-recurring consulting engagements, and this project-based work makes it vulnerable to fluctuations in client spending, especially during economic downturns. I also have listed competition from other research providers. I actually work in the market research field, and there are a lot of research providers out there offering similar things. I've actually never personally worked with Gartner, despite having worked for some big and still do work for some big companies. So I think that they may be facing some increased competition in the future, which could potentially impact market share and pricing power. Next, I'd like to talk about a couple of KPIs to track. This is one area that I did not touch on in my second episode, Rollins Inc., and I think I'd like to integrate into future episodes. So for Gartner, I've got 3 KPIs to pay attention to. First is global contract value. This is the annualized dollar value of all subscription-related contracts at a specific point in time. It serves as a key indicator of their financial health and growth potential, and provides a clear indicator of also client demand for its research services. Next is research wallet retention. This KPI showcases Gartner's ability to not only retain clients, but also expand their spending, demonstrating the company's value proposition and the stickiness of their services in a competitive market. Third, the leverage ratio. Gartner defines this as gross debt divided by trailing 12-month adjusted EBITDA. Their investor presentation mentions a target of 2 to 2.5x leverage. So given their debt situation, I think this is a key metric to pay attention to. Also, as of Q4 23, their leverage ratio was 1.7x, slightly below their target. I'd then like to go into a financial statement overview. First, the income statement. Revenue is nicely split out for us between the 3 segments: research, conferences, and consulting. This is nice to see. The largest operating expenses are SG&A, which includes salary expense, real estate footprint, etc. This is around 45% of net revenue. And also cost of services and product development, which includes headcount, has been around 30% of net revenue. Given Gartner's history of acquisitions, I think it's also important to pay attention to the acquisition and integration charges line item, and amortization of intangibles is also worthwhile to track. I then like to look at just interest coverage ratio. This measures how many times earnings a company can pay back its interest expense on outstanding debt. I usually like for this ratio to be at least 10.0 with a minimum of 5.0. For Gartner, interest coverage has never been higher than 9.0 over the last 5 years, although it is worth calling out that their latest quarter interest coverage ratio is actually 15.97. The software industry median on Google Focus is 29.61, so Gartner comes up a little short of my benchmarks here. In terms of the balance sheet, Gartner's top assets include goodwill, fees receivable, and cash, while top liabilities include deferred revenues and long-term debt. Not surprisingly, Gartner has a significant amount of deferred revenue, which represents those future obligations to deliver services to clients who have prepaid. I then like to assess if goodwill is less than around 30% of total assets as a benchmark. In Gartner's case, it's not. In 2022, goodwill was 40% of total assets, and in 2023, it was 37%. This large goodwill balance suggests that Gartner has grown significantly through acquisitions, potentially exposing the company to risk if acquisitions don't perform as expected. I then like to discuss the debt to equity ratio and the cash to debt ratio. Trailing 12-month debt to equity, which is I found on stockanalysis.com, is 453%, which is way above my 150% threshold. This means that they have $4.53 of debt for every $1 of equity. Not ideal for me. With that said, their cash to debt ratio is much more reasonable, sitting at 0.43 in 2023 and trending up over the last 5 years. Ideally, I'd like for this ratio to be at or above 1.0, which would mean the company is in a net cash position. Next, the cash flow statement. Stock-based compensation has consistently been well below 10% of revenue for the last 10 years, ranging from 1.53% to 2.38%, and this meets my criteria of being consistently less than 10% of revenue. CapEx has also been consistently below 5% of revenue for all 10 years, ranging from 1.26% to 3.51%. I will note that SBC and CapEx are a little higher than the 2023 industry averages for Gartner, and this is from Professor Aswath Demordian's database. The annual net acquisitions divestitures data shows that Gartner has been making relatively small acquisitions in recent years, with amounts ranging from about $2 million to $10 million. In 2023, Gartner reported a gain from sale of Talent Neuron, which was originally part of 2017's CEB acquisition, and this gain was for $135 million. Gartner does not pay dividends, but they do have an active share buyback program that we'll discuss in just a few minutes. I'd now like to talk about management. First, a leadership overview. Gartner is not founder-led. They were founded in 1979 by Gideon Gartner, but he is no longer involved in the company's operations. We'll then talk about how the current CEO, Gene Hall, has been Gartner's CEO since 2004, which is nearly about 20 years. This is significantly longer than the US average of 4.6 years and something I like to see. In fact, Hall's contract has recently been extended through December 31st, 2031, which would bring his total tenure to almost 30 years. I'd like to just do a quick Glassdoor review of the business. Gartner's scored very impressively on Glassdoor. They had a 81% would you recommend to a friend rating, which hits my top quartile benchmark in the database. They also have a 91% approval of their CEO, and nearly 80% have a positive business outlook. In terms of compensation, Gartner's executive compensation plan was established in 2006, and they really emphasize a pay for performance. I've noted a few key features. 70% of equity awards and 100% of bonuses vest based on performance objectives. Also, 94% of the CEO's compensation is incentive-based, and 86% of his compensation is in equity awards, which focus more on long-term performance. Equity awards have a 4-year vesting period, which I think aligns executives with stockholder interest. There's also 3 components to compensation: a base salary, short-term incentive compensation, which are cash bonuses, and long-term incentive compensation, which is equity awards. Gartner's short-term cash bonus plan for executives is based solely on company-wide financial performance. The plan uses 2 equally weighted metrics, EBITDA 50% and revenue 50%. My only gripe here is with EBITDA. I would prefer EBIT or free cash flow. Gartner's long-term equity incentive compensation is based around contract value, which I do like to see. And in 2023, their payout was 114% of target. Overall, I'm okay with this compensation plan, especially since 86% of the CEO's pay is based on contract value, 8% on bonus, with EBITDA being the only issue there, and 6% on base pay, which is $963,000 in 2023, relatively below average for companies with over $1 billion in revenue. While there is no Morningstar capital allocation rating, their capital allocation strategy aligns most closely with the maturity stage of a business life cycle. Their free cash flow is used to offset equity dilution for opportunistic price-sensitive stock repurchases, and they have about $1 billion remaining in their repurchase authorizations. And then lastly, for tuck-in acquisitions, as they've noted. They do also note that there are no current plans for material debt repayments. 2 other things that I like to look at in capital allocation is their 5-year trend in diluted shares outstanding less than 1%? For Gartner, yes, their 5-year trend shows a decrease of 12% in diluted shares outstanding. I then like to look at their 5-year average total shareholder distribution to free cash flow ratio, which just says between dividends and buybacks, are they giving out more than the free cash flow they generate? We'd like for this to be below 100%. For Gartner, that 5-year average is 73%. In terms of ownership structure, not a whole lot to report here. Insider ownership is relatively low, around 3 to 4%, which does fall below my benchmark of 15%. And it also means that management compensation matters more. But given the above, I'm okay with that. For institutional ownership, it's reported to be around 90%, which does exceed my benchmark of 75% and can be seen as a positive sign. Next, valuation and technical analysis. For valuation, I first like to start with the DCF from investorsgrow.com. Using a 9% required return, a 2.5% perpetual growth rate, and 5 years of analysts' free cash flow forecast, and there are 18 total analysts in that, Gartner's fair value is around $280, which would indicate 81% overvaluation at their current price of $507. I'd next like to do a reverse DCF from Stock Investor IQ. Using trailing 12-month free cash flow per share, a 9% required return, and a 15 price to free cash flow terminal multiple, Gartner needs their free cash flow per share to grow 15% per year for 10 years to justify the current price. This is actually right in line with their 10-year average of 14.5%, indicating fair value. Next, free cash flow yield. Their trailing 12-month free cash flow yield using enterprise value is 2.46%, versus a 10-year average of 3.52%, indicating that Gartner is currently valued at a premium relative to its historical cash flow generation. Using trailing 12-month free cash flow and their 10-year average free cash flow yield, the implied stock price would be about $343. If you use a forecasted free cash flow of $1.25 billion for 2025, their free cash flow yield is still 3.06%, which is below the 10-year average. Next, I'd like to look at two multiples from Guru Focus, EV to EBIT and EV to revenue. Their EV to EBIT is currently at 34.86, which is higher than their 10-year median of 29.13 and the software industry median of 17.4. This suggests that Gartner is trading about a 20% premium to its historical valuation and then a 100% premium to its software peers. If you take their 10-year median multiple, this implies a stock price for Gartner of $405. Their EV to revenue. Their current EV to revenue is 6.79 versus a 4.15 10-year median and a 2.07 software industry median. Their 10-year median multiple implies a stock price of around $300. Overall, Gartner's current market valuation suggests that investors are highly optimistic about Gartner's future growth prospects. In my opinion, fair value seems to be in the $300 to $460 range. Lastly, I like to look at a very quick technical analysis. Are they on a long-term price uptrend? Yes, they are, with the stock price seeing a big boost from 2021 onwards. How does their current price compare to their 1-year and 5-year 200-day exponential moving average? Their current price of $507 is above both their 1-year and 5-year 200-day exponential moving average of $448 and $337 respectively. This indicates bullish momentum. In summary, Gartner Inc., ticker symbol IT, is a leading technology research and advisory company with a robust subscription-based business model where 76% of revenue comes from recurring research subscriptions. Pros include high client retention rates of 80 to 90%, strong pricing power, and a diverse customer base across over 15,000 enterprise clients. The company's resilience during economic downturns and its effective thought leadership, exemplified by tools like the Magic Quadrant, further bolster its market position. However, potential investors should be mindful of Gartner's higher debt levels, stretched valuation, and personnel-driven business. I really like Gartner a lot and would love to add it to my portfolio. Since I already have a full 20-company portfolio, I plan to add Gartner to my watch list with a buy range between $330 and $450. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Gartner Inc. both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, or drop a comment. Your feedback helps us grow. For real-time updates and insights, follow me on Twitter, X, at Invest091. Join me next on Wednesday, October 9th, when I'll go into more detail about my investment checklist and benchmarks. Until then, keep your investments smart.